Now, when should we test for impairment? That is the next important question. Now, when should management test for an impairment of an asset, right? So, for that, what the standard says is, at each reporting date, you must assess whether there are indications of impairment. So, there is a responsibility or there is an onus on the management that at every reporting period end, so let's say you are reporting a financial statements as on 31st of December of a particular year, on that date you have to check whether there are indicators of impairment. See, before you go into this calculation, first you have to decide or first you have to check whether there are indicators of impairment. If there are indicators of impairment, then you will determine the value in use and net realizable value, because see, value in use is a very complex exercise. If I have to say for a group of assets, I have to calculate the cash flow, it needs lot of time and lot of effort. So, before you go into calculating impairment loss, you have to check whether there are indicators of impairment. Are there any indicators of impairment? When should we do this? At the end of each reporting date or at each reporting date. Now, let's say an entity is publishing quarterly financial statements. So, in that case, every quarter end, whenever the financial statements are being prepared, on that date you have to say or you have to check whether there are any indicators of impairment. Okay. Now, what are the indicators? The standard classifies into two parts: external sources and internal sources. External is something which is outside the entity, right? So, now external sources could be, one simple example could be, suddenly let's say I have an investment property, the market value of those investment properties have crashed in this area, okay. So, market values of the investment property has crashed means the rental income, rentals also would have crashed. So, that could be an indicator that there is an impairment, right. So, first is asset market value has declined more than expected. So, the asset value has declined. In case of land and building, instead of going up, it is continuously going down, okay. Or in cases of when you have these assets related to technology, for example, computers or for your mobile equipments or any technology used in, let's say, a manufacturing process, these technologies get outdated pretty fast, right. So, when these get outdated pretty fast, the value of these technology will also keep on falling. So, that could be an indicator of impairment. Now, one thing you have to understand here is, we expected that the value of the technology will fall down like this, okay. If it falls in the same pattern, then there is no indicator of impairment, because that is our expectation. But, and based on this expectation only, we will amortize the asset. But what happened is, actually the value of the technology fell like this, okay. That's still better. The value of the technology fell like this, okay. So, if there is a sharp decline which is not expected, then there could be an indicator of impairment, okay. So, these are like symptoms. So, when do you go to a doctor and get tested, or when does a doctor say to some test to be done? There has to be some indicator. Not that every time you have cough and cold, the doctor will ask you to go for a COVID test, correct? The doctor will see what are the symptoms, and if those symptoms tell that yes, there is a chance that there may be a COVID infection, then the doctor would say, please do this COVID related test, right? Same thing works here, that your indicator, what is the indicator? Market value has declined, or there are changes in technological, market, economic or legal environment that have an adverse effect on the entity. So, this one very classic example again could be for COVID times. Of course, it was temporary, but then let us say there are continuous lockdowns because of which the economic activity has gone down, or in the country of operation there is severe recession. If there is recession, demand will be lesser, cash flows and the value in use will automatically go off, right? Then, if there are some legal restrictions, for example, let's say an entity has a particular technology which is purchased, okay, and that technology is subject to some lawsuit, or there is some patent infringement because of which we cannot use the technology. So, in that case, because of the restriction on using the technology, you will not get the value that you have expected from the technology. So, that can be impaired. Then interest rates have increased. Now, this is very interesting case where we have to go back to our example. Same example I am just taking up here. Let us say interest rates have suddenly increased. Now, we have seen, right, interest rates have increased. Let's say interest rates have increased to 12%. Now, note this number. This is 76,183. Now, if interest rate have increased to 12%, what will happen is, this will be 1.12, this will be 1.12, this also will be 12%. Now, what happened? The value of the asset, the present value of the cash flows, the value in use has gone down. So, if the interest rates increase, then there is a possibility that the value in use has reduced, and hence there is a possibility that there could be impairment. This does not mean that there is actually an impairment. This is just an indication that there could be an impairment. Then, internal sources are, there is evidence of obsolescence or damage to the asset. The asset that we are using is actually damaged or it has become outdated. So, there could be an impairment. Then, changes in the way the asset is used have occurred or are imminent. Meaning to say, we were using a particular asset in a one particular way, let's say in our factory, a particular plant. Now, because of changes in the customer preferences, we are not able to use it in that particular way. We have to use it for some other purpose. Now, if you use it for some other purpose, you will of course not get the value that you have expected. Then, evidence is available from internal reporting indicating that economic performance of an asset is or will be worse than expected. So, this is by evaluating the internal reporting, the management reporting. We expected that the benefit will be 100, but now the benefit is only 80 or benefit is only 70, and this is available, this is evidenced from the discussions with the management, right? So, there could be external, there could be internal, these are limited sources, there could be other external sources, there could be something like a damage occur due to fire, okay, so that could impair an asset, right? Or the machine has breakdown or is continuously breaking down, that could indicate an impairment, right? For example, you have purchased a car is expected to run smoothly for at least 2 lakh kilometers. Within 50,000 kilometers, every month or every 2 months, you have to take it to the workshop. Means what? There is an indication that the asset may have been impaired. Now, impaired, if I have to put a very parallel connotation, or if I have to use another word, it is more to do with damaged. Okay. Now, here damaged in terms of what? Damaged in terms of financial value. See, a physical damage will of course lead to a financial damage, that's of course there, but otherwise also, is there some kind of financial damage based on these information of internal and external sources. Now, if there is an indicator, what you have to do? Every period and every reporting period, you have to see whether they are indicators. If there are indicators, then you have to do impairment testing. Means calculate the value in use, calculate the net realizable value, determine the recoverable amount, compare that with the carrying amount, and decide whether there is impairment or not. Okay, anything, any questions here?
In real scenarios, what will be the, like when auditor questions this test for the impairment, what is the management replies?
Management will have to give evidences, no? So, basically you will rely on the budgets of the management, you will have to look at the board meetings, you will have to look at the, the reporting they are doing to the audit committee. Okay, you have to ask for them, what is that they are discussing, what is their next 2-year plan, 3-year plan of using that asset, if at all there is an indicator of impairment. Okay, now see, lot of things that Ind AS does is, it puts, IAS, keep on referring to Ind AS, a lot of things that IAS does is, this International Financial Reporting Standards that we are referring to, they put a lot of work on the management. It has to be management estimate, it has to be management discretion, it has to be management judgment, okay. Now, you cannot question somebody else's judgment, right? For example, I am saying my computer that I am using, this is worth 1 lakh for me. You may say, no, this is not worth 1 lakh, this is 5-year-old computer, this is worth only 50,000, okay. Now, that is a question of judgment. So, if at all you are not able to get enough evidences after asking even relevant questions, then the only option available to you is to get a representation letter from the management that yes, based on these things, management believes that the value of this asset is so much, right? So, I don't know, are you working somewhere as an auditor or are you working as an audit assistant or something?
No, sir.
No, okay. Okay.
We used to get yellow
Signed what?
Yellow as a letter of representation.
Correct. So, you will get that letter of representation, and because see, it is a management call, okay. So, now just to get out of this our discussion of financial reporting and looking at the overall picture, as an auditor, okay, there are two parties now. This is relevant for the management for doing the testing and all of that, and as an auditor, the auditor has all the right to question the management, but then it is the management who will decide what is to be done with the business. Auditor cannot decide or auditor cannot tell the management what should they do in the business. It is the management's call as to what they want to do in the business. Okay. the role of the auditor is to see whatever is being presented in the financial statements, whether that reflects the actual business sense, whether that gives a true and fair presentation of what the business is doing. That is the auditor's role. Now, auditor, if it believes, or if the auditor believes that this asset must have been impaired, okay, now you can go beyond and maybe you can get certificate from a certified valuer, independent valuer, right? You can look at similar companies, what they are doing, right? So then once you do all of these things, you will have evidences. Even after that you are feeling that no, I am not able to decide, then you may have to discuss this with the management and those charged with governance, and then give an appropriate opinion, maybe a qualified opinion or maybe a disclaimer of opinion if you are not able to prove it, right? So the thing that you have to keep in mind is, as an auditor, you can only question so much to get the evidence that you want. You cannot go or you cannot overstep into the functions of the management. Finally, it is management who has to decide that yes, this is impaired or this is not impaired. You have to check and see whether that assessment is correct or not, right? Now, when there are no indication of impairment, then you don't need to do anything except that you have to do annual impairment for these 3 items. Okay, so for all other assets, you have to do that impairment testing only if there are indicators of impairment. But for these 3 specific items, you have to do impairment or you have to carry out impairment testing only if, every year, even if there are no impairment indicators. So, if these indicators exist, you will do impairment testing, but for these 3, you will do at least an annual impairment review. What are those 3 assets? First one is goodwill acquired in a business combination. This is covered by IFRS 3. Goodwill acquired in a business combination covered by IFRS 3. Okay, that is the first thing. Let me change the color of the text. So, if there is a goodwill acquired in business combination, whether there are indications of impairment or not, every year, at least once in a year, you will have to do a test for impairment. Then, an intangible asset with indefinite useful life. So, the thing here, specific thing that you have to understand here is, if there is an intangible asset which does not have a definite useful life, you will anyway not amortize it. So, it is more important for you to check whether the intangible asset has been impaired or not. For example, we have purchased a technology. We believe that the technology can last for a long time. We cannot decide the life. But then, who knows, after 2 years or 3 years, the technology may not be useful at all, right? So, for that, every period you have to do a impairment testing. And an intangible asset which is not yet available for use. Now, what do you mean by that? This is in progress. You are developing something. It is in the development stage and you are not yet using it. For that also you have to see whether that intangible asset has been impaired or not. Now, you might be wondering, sir, how can we test an intangible asset which is not yet available for use? So, what you need to do is, there is a carrying amount of the development stage intangible asset. Then parallelly you have to see what will be the cash flows in the future, what will be the future economic benefits, what will be the recoverable amount, and that you have to compare with the intangible development work, intangible under development, and decide whether there is impairment or not. So, you have to do an annual impairment review for these assets irrespective of whether there is an indication of impairment or not. Quickly, 3 things: goodwill which arises out of a business combination, then intangible assets with indefinite useful life, and intangible assets which are not yet available for use, which are under development, right? So, for these 3, you will have to calculate or you will have to check for impairment at least once a year.
Sir.
Yes.
Sir, I have a small doubt, sir. The rate of interest what we use for calculating present value and future value, that rate is actually is an inflation rate, what the value of rupee in future and current?
Not only the inflation, not only the inflation rate. So, what the standard says is you have to take the risk-free rate. Then you have to adjust it with the appropriate risk which is attributable to the business. Okay. Considering that, and of course, inflation plays an important factor. Considering all of these, you have to calculate a rate that is, appropriate for discounting. So, see, one more thing is, some of these things we'll learn now, and some of these things we'll learn in, SBR, that is your level 3. Okay, so same things, you will realize later that same concepts again we will repeat at an advanced level in, level 3. And IAS gives a detailed thing around how to calculate interest and all of that. So I'll just, because you have asked this question, I'll just show that to you. This is too much of an advanced concept. Okay, you are not required to do it at level 2. Can you see this? IAS India 36, same concepts are same, so there's no difference there. Okay, so discount rate ke upar there is a lot of thing. How should we do? So for example, you start with, as I told you, a risk-free rate. Okay, then you will have to adjust for the risks that are there. Okay, then the time value of the money is considered, of course. Then you have to consider weighted average cost of capital, then entity's incremental borrowing rate or other market borrowing rate. Then you will have to look at the way market would assess the specific risk with the asset, then exclude the risks that are not relevant to the asset's estimated cash flows. Okay, then you will give risks such as country risk, currency risk, price risk. Okay, and it is independent of the entity's capital structure, and it has to be a pre-tax rate. Okay, so that is also very important, right? So this is the guidance given in the standard, about a couple of pages of thing given, right? So this guidance is what you will apply to determine the interest rate. Now, as far as we are concerned at level 2, we will be given the discount rate in the question. We don't need to compute the discount rate. Even in the final level also, you will not be asked to compute. They may sometimes tell you that, okay, this is the risk-free rate and this is the risk premium. That is what they might ask. You will not be required to go into too much of detail of how to calculate, right?
Yes, sir. As of now, we'll just look at the rate what they give.
Correct. So they will give you the rate, and then based on that rate, you can calculate it. Once you understand these core concepts, remaining concepts you can, once you qualify, once you start working, you will automatically start understanding things, right? So that is where the structure of having some standards component at level 2 and having advanced concepts in level 3, right? So that is where this is slightly better. So for example, same things, PPA and all of that, again we will be repeating in SBR with more depth in understanding and application, right?